looking here also, and if you remember, there was a very popular, I won't mention any names, but a very popular, investor that was buying this stock. If you remember, Valiant Pharmaceutical, and this came below the 200-day, right? Went into a stage 4 downtrend. And this is where, no matter how good the story is, no matter who's buying it, no matter what you hear on the news, you should be avoiding the stock. The stock is telling you, and even some of the smartest investors that were buying this all the way down, and then this stock went down 93% in just 15 months. And again, there was, people buying this stock, hedge fund managers buying the stock, and people that believed in the story. You really got to keep your eyes peeled here for the trend, and make sure that you always have the wind in your sails. The trend is your friend. There's a reason why that saying has been coined.
Yeah, and the other thing on that example is one of the most basic rules is that you want to. The stocks that you own should be in an uptrend above the 200-day moving average, and that 200-day moving average in an uptrend. When that started rolling over and that 200-day moving average started dropping in November of that, it looks like November of 16, that you should have been out. And that's how all your stocks should be. You should only be in stocks that are in, as we go back to the beginning, stage 2 uptrends.
That's right. Now, just think of it as having the wind in your sails when you're in an uptrend. And then when you come under the 200-day and the 200-day rolls over, now you're going into the wind. You're trying to sail into the wind, or you're trying to swim against this big tide. Now, we're going to show you in just a second. There's the 8 criteria. We're talking about the 200-day, but there's some other criteria too, and I'll show you that in just a second. Now, here's a interesting thing where this is a stock that I actually added to our short list for our clients, but it was a long. So you can see here, this was what we call a power play, where the stock, after you had an IPO, and then it formed this little base right here. This was what we call a power play, or also referred to as a high tight flag as well. And then you see, you make a nice quick move. You're able to capture a real nice move here in just, 10 weeks or so. And then that stock starts topping. And now it rolls over, and now it's a short. That same stock is a short, all within, a time frame of, just a couple years, and then rolls over. And look at this, boom. Right? Because now the momentum is to the downside, and now you get the same type of situation that you have here on the upside. You're getting in reverse, as Dave said, on the downside. Now, another thing to talk about too is that you can transition. You don't have to. You could be in a stage 1. You don't necessarily have to go from stage 1 to 2 to 3 to 4. You could go 1, maybe briefly in 2, and go right into 4. You can go from 1 to 4. The key is to gauge what stage you're in at any one time. Not worry about the chronology of it, but just make sure that you're in the correct stage. So here's a stage 1 that's breaking out. Nice base here. And you can even buy coming out of a stage 1 if it's just turning into a stage 2. And we'll talk about that later on. It's what we call an early turn. But you have to be very careful when you just get in, when it's just starting to turn up, because you don't have that confirmation. It hasn't proven itself that trend is going to hold. And this was going right into the the banking crisis here, and going into the 08, 09 decline. And this is Citigroup. All right, Citigroup comes out of a nice base, and you've got to always be ready to switch gears. I always say, if you're in cash, you got to be prepared to go long. If you're long, you got to be prepared to go to cash. Always entertain or always be prepared for the opposite side of the trade. So, don't form an opinion here. It came out of a big base. Oh boy, I'm in a stage 2 uptrend. Everything's okay. And now it quickly rolls over. Now, of course, if you had a stop loss, you'd be knocked out of this. Something like, Bank of America here, same thing. Came out of a base, gets into a stage 2 uptrend, and you should be selling here. Whereas your first point where this is not acting so well, if you didn't sell there, definitely here, and without a question here, because now you're rolling over and you're really starting to turn into that stage 4. So if you know these stages, you're going to know if you should be entertaining the stock or not even thinking of it. Now, you remember earlier I talked about how we're going to start at a satellite view, then we're going to come down to an aerial view, then go to an overhead, and then to a microscopic view, and really get right down to the buy point, specific days, volume analysis, and price, right to the very day of the buy point and selling rules. Right now, we're just starting to come down a little bit and go to maybe an aerial view, right? We gave you that big perspective talking about the categories and valuation. Now we're coming down to an aerial view. Still, though, this is still perspective, but we now have some real rules, right? Where this is also applicable. These are decisions that or things that you're going to look at to qualify the trade. All right. So you want to, this is what we call a qualifier. Non-negotiable by criteria means that this isn't open for negotiation, right? There's not, well, but, it has big earnings, or well, but it's Amazon. This is, if the stock is not in a stage 2 uptrend, you avoid it. And you should be setting up, and I'll show you later on in MarketSmith, there's some, my templates are in there. So you don't need to go and program this or worry about it. There's some already pre-programmed formulas in there that you can run. And we'll do that a little later on. I don't want to get to that just yet. So another thing too is, don't get enamored with bank or upgrades or recommendations from, Goldman Sachs put it on their buy list, but it's in a stage 3 or a stage 4. So this is a perfect example. I always like to show this. We put this stock on the short list. We initiated this as a short alert on July 9th of 2012. Just shortly after, all right, 5 days later, Citigroup upgrades it to a buy. And 3 days later, look at this. Pow, it gets creamed. 3 days later, it's down 23%, comes down much more, has a brief rally, and just gets annihilated. And the stock almost cuts in half. This is after Citigroup puts it on buy. So again, don't get enamored with brokerage firm upgrades or buys, or whether Kramer, whoever's talking about it, the stock is telling you that the wind is in your face now, and you got to avoid the stock. Do you even pay attention, Dave, to upgrades from brokerage houses or anything like that?
No, and lots of times brokerage firms, houses sometimes upgrade the stock, and their clients sell right into it. You just have to look at the market action itself and not let opinions of other people. You can do, with the right rules, the right set of rules, the right discipline, you can do so much better than most analysts on Wall Street.
And what Dave just said, that really pretty much sums up what we're doing here. We're going to give you all the tools and everything so you could be independent. You can make these decisions on your own, and you're not going to be able to have to ask anybody's opinion, or you're not going to be able to have to look at newsletters and listen to the TV and all the pundits. You're going to be able to make these decisions on your own. Now, this is a term that years and years ago, when Dave first started doing the Master Trader program with me, he termed the serial gapper, and it couldn't be any more apropos, if you will. What happens is, when you're in an uptrend, you get a lot of happy surprises. Stocks gap up. They do well on earnings reports. You get happy surprises. It's a serial gapper on the upside. But when you go into a downtrend, it just the opposite happens. So you increase your risk of volatility. You increase your risk of waking up the next morning and having the stock be down big on a gap. A lot of times, even on good news, the stock will gap down. And so this is a perfect example. This is another stock that we put on the short list as it broke through the 200-day. I put it on the short sale alert list, and look at all these gaps. Look at all the way. And then at the end, they really start to accelerate. And this stock is another stock that cut itself in half. Again, this is a good time to talk about the 50-80 rule. So another thing that we've gone back and looked at, and I talk about this in my book. O'Neill talks about it in some of his books too, about the kind of decline, the average decline that a stock will go through. A leader, a past leader, a secular leader, that once it tops, the average decline is 72%. And this is a rough rule of thumb, but it's a rule that I've come up with. I call it the 50-80 rule. 50% of past leaders, once they top, will go down 80%, and 80% will go down 50%. That is a very sobering statistic. It's a scary statistic if you start holding stocks in stage 4 downtrends and you're in a prior leader that tops. This happens all the time, and this will happen with Amazon. This will happen with Google, with all these names that everybody's completely convinced that they can never go down 50 or 80%. I assure you that Amazon, Google, Netflix, PayPal, all these names that are these Facebook, that are the rocks of Gibraltar of the market here. I assure you that at some point those stocks, the 50-80 rule, they will succumb to the 50-80 rule, and it'll be too late. If you're sitting there trying to buy them in a stage 4 downtrend, you get yourself in big trouble. It might blow your account up.
Yeah, and I just add, do not fall in love with your stock. I mean, yes, it's great when you're aboard a stock and you've held it for months and maybe even a few years, but when the characteristics change, you've got to not treat it as your own little baby and I can never sell it. Well, you can see just in some of these examples what can happen when a downtrend starts. You have no idea how far it can go. So you just, and I know people get enamored with certain names. I've got to own this. I've got to own this. But there always comes a time where those great names can underperform for much, much longer than you can ever think.
Yeah, and I'll follow up on that by saying, look, first of all, if you're going to fall in love with the stock, you fall in love with it while it's in a stage 2 uptrend. You're never going to fall in love with the stock once it's in stage 3, stage 4, or even stage 1. But if you're going to fall in, but here's the thing, you don't marry a stock. All right. You may hold it for a while. You date stocks. They're not to be married. I know some people, if I held Amazon all these years, first of all, you wouldn't have held Amazon. If you bought a stock and then it went up, I don't know, 1,000%, you'd probably sell it at some point on some correction or take your profit. Now it goes up 5,000, 10,000. Very few people are going to hold a stock for an 80,000% move. But here's the main point. Plan for a divorce. Okay, at some point you're gonna get a divorce from your stock. You're gonna have to get it, whether it's forced or it's something that you planned for. There will be a divorce. I assure you, at some point, all stocks you will end up having to have a forced divorce. So don't marry them, and if you do marry them, plan for a divorce. All right. So real quick. This is just, I'm not going to go through this, but this is the transition criteria. So when you're watching stocks, if you're watching stocks maybe in stage 1 bottoming, a lot of people are like, well, I want to get a lead ahead of it and watch it before their stage 2. I can get it right when they turn to stage 2. Like I said before, I'm going to show you in just a second. We have some screens in MarketSmith that you can run that'll show you that transition. But if you're not using MarketSmith and you're just looking at stocks, these are the transition rules. This is what you want to see on the daily and the weekly. I just put that out there for you. You can look at that at your own time.